Once you become clear that the true fundamental value of an ounce of gold at this moment, before more money printing, is somewhere between $38,000 and $40,000, and the true fundamental value of an ounce of silver before they do anything else is somewhere between $1,800 and $2,000. So you can see the support on spot gold is at about 4,400. That's the first line, and you've got a ton of support, a ton of it, at 3,450. Let's take a look at the support levels in spot silver. The first one that I find is 59. And it doesn't mean that it's going to go down to that, mind you, but you asked me where the support is, so I'm showing you. We've got a support level of 59. The next one below that is 55, and the one below that is 39.
Lynette Zang, a longtime precious metals analyst and economic commentator, shares her latest outlook on gold and silver markets amid growing concerns about global money printing and currency debasement. In her recent forecast, she explains that the true fundamental value of gold could range between $38,000 and $40,000 per ounce before additional monetary expansion. For silver, she suggests a potential fundamental value between $1,800 and $2,000 per ounce under the same conditions. While current spot prices remain far below those projections, she identifies key technical support levels that investors are watching closely. Gold shows initial support near $4,400, with significantly stronger backing around $3,450. In the silver market, primary support appears at $59, followed by $55, and then a deeper level near $39. These price zones help traders understand potential downside risk while keeping long-term bullish projections in focus. If you found this gold and silver market analysis valuable, smash that like button, share it with fellow investors, and subscribe now to stay ahead with the latest precious metals updates and insights.
Once you become clear that the true fundamental value of an ounce of gold at this moment, before more money printing, is somewhere between $38,000 and $40,000, and the true fundamental value of an ounce of silver before they do anything else is somewhere between $1,800 and $2,000, then if I paid $350 for it, what difference did it make, right? Just like my necklace that you see me wear that I bought back in 1987 when I first moved here for $350, and the latest appraisal was $6,500. Just the gold content weight, I turned it off. Give me a zero. Just the gold content weight of that is 1.6 ounces. Do you see what I'm saying? It's not that gold is going up. It's the value of the dollar going down. And gold and silver in any form will hold your purchasing power intact. It's the way that you hold it and the variety of ways that you can hold it. So the strategy isn't switching mints or crossing borders. It's stepping into forms of metals that give you insulation, privacy, and control, no matter what jurisdiction you're standing in. So now I'm going to go to, I need the slides up, because Daniel Mastrocco last week said, I'm curious what the 5 gold confiscations in the U.S. government has done. Google doesn't provide the results. Maybe you can make a short video on that. And that's what I'm doing. So these are, and actually when I went back and I kind of looked at the definition, again, I'm wrong. Right? It's not 5 times, it's 7 times. And I'm also not just looking at the overt confiscations, but the currency revaluations. And I didn't have those in my list. The two, oh, did I say this? The two that happened in 1973, the first one in January, which was just under 10% revaluation, and the one in February that was just over a 10% revaluation. They did it in measured strokes so that you and I, well, those of us that were around then, didn't really notice it too much, except I can tell you, I remember the inflation that was happening during that period of time a lot, something about 45%. So I think it just missed the hyperinflation definition of 50%. But here they are. In 1812, contracts that were invalidated and the mints were closed. In the 1860s, the government went further by physically confiscating gold and voiding private contracts. In 33, citizens were forced to surrender their gold, and in 34, the government revalued it overnight, capturing 40% of the public's wealth with a single stroke. And guess what? Based on all the money that they created up to 33, they should have done it to 42.22, but they knew that the public wouldn't be able to tolerate it. So we started out, even after the revaluations, in a deficit. In 1971, convertibility for other governments was cut off entirely. That was a Bretton Woods default. And, I never really thought about it as a confiscation, but it was totally a confiscation because foreign governments that were holding their gold here with the promise that they could exchange dollars for gold anytime they wanted, that was the default. Right? Because we said, nope, you can't do it anymore, which means that the U.S. confiscated the global gold. And by 73, that gold was revalued twice more. So understand this, the pattern is unmistakable because, let me show you this. I thought, well, here's just a list of all the times just since, I think we go to 1812, the number of times and the different countries that have done overt and reasonably covert confiscations. The pattern, right, during wars, depression, currency instability, the government protects itself first, right? They flip-flop the Constitution, where it used to be that the individual was the head, and then the states were supposed to support the individual rights, and then the federal government was supposed to support the states who were supposed to support the individual rights. That's been flip-flopped. And you need to understand that it's not always through overt seizures. Sometimes through revaluation, for bans, for forced sales, inflation, taxation. At the end, the result is the same. Citizens lose their purchasing power if they believe the lies. And we know, how many times can you be lied to and you do not know the truth? History doesn't repeat perfectly, but it rhymes. And every rhyme points to the same truth. In a crisis, gold moves. Governments try to move faster because whoever holds the gold holds control.
A growing number of analysts argue that gold and silver are not truly rising in value. Instead, the dollar's purchasing power is declining. Current projections suggest gold's fundamental value could range between $38,000 and $40,000 per ounce, while silver may stand between $1,800 and $2,000 before further monetary expansion. From this perspective, owning physical metal at far lower prices represents preserved wealth rather than speculation. Historical patterns in the United States reinforce this view. Since 1812, there have been multiple gold-related interventions, including contract invalidations, forced surrender in 1933, a 40% overnight revaluation in 1934, and the 1971 suspension of dollar convertibility under Bretton Woods. Additional revaluations followed in 1973. These actions, whether overt confiscation or currency devaluation, consistently reduced public purchasing power. In times of war, depression, or monetary instability, governments act to protect financial systems, often at the expense of currency holders. Let's get into the interview.
The next domino begins to lean, and that's the gold contracts. Let's look at how that paper market is tilting the biggest piece in the chain. Let's see. Spot gold. This is the spot gold contract. Okay. What I also want to show you in here are the technical moves, because on 2/6 we were at 49. So I just did this. What's today? Today's the 10th. Okay. So this is, I pulled from Friday, and you can see that big, huge correction. Now, I want to remind you, first of all, that the distance from that 50-day moving average that we've been talking about now for quite some time is 9.45. 10% is a lot. So it's still a lot away above that 50-day moving average. But the 200-day moving average is still 37.38% away. That is extreme. That is showing a massive divergence from its long-term trend. It's not spot gold drifting higher. It's tilting, it's leaning far above that 200-day moving average. And that kind of move doesn't come from the physical part of the buying, though we are, and I cannot wait until it's complete, but it's not complete yet. That transition from the paper markets dictating the visible price to those physical markets dictating the true supply and demand price. What you're looking at in the paper market are futures, options, swaps, unallocated accounts. You're looking at shorts and naked shorts and all sorts of things. Leverage, leverage, leverage. And leverage means you got a teeny weeny bit of equity and lots of debt on top of it that can topple the whole entire system. Remember, 2019, I don't know exactly where it is today, but according to the Bank for International Settlements, for every 1 physical ounce of gold in any form that existed, there were 64,000 ounces of digital gold. And that was 2019, before the party really started. So keep that in mind, because when gold stretches this far above its trend line, it's not because the physical market is tight, it's because the paper market is unstable. The contracts are wobbling, the leverage is swaying, and gold, spot gold, the biggest domino in the line because it's a paper contract, is starting to lean. And there's your volatility. It does not mean that it is overvalued. Nothing goes straight up. Nothing goes straight down. You get bouncing along the way. And I've shown you this before. Markets can stay irrational a lot longer than you would ever think possible, but they can. However, they could just be staying in this range, giving that 200-day moving average a chance to catch up. That's the technical part of it. But frankly, if gold is leaning, silver's racing because it's the smallest domino in the chain. It moves the fastest. And this next slide, whoops. Yeah, this isn't, not ready yet. Sorry, I'm a little ahead of myself, but you guys will forgive me. Because you asked me last week where was support, so that's what I pulled. So you can see, and all you have to do is pull up any chart and pull up a ruler or some kind of straight edge and start drawing lines, right? So you can see the support on spot gold is at about 4,400. That's the first line. And then I did another one because remember, once a support on the bottom line is broken, that then becomes the resistance on the top. Okay. So the next support line below is 3,900. And you could just see where it hit and then it bounced up. And then this last one, which I do not think we're going to get to any one of these levels. Maybe 4,400, but you asked me where the support levels are. That's why I'm showing you this. And you've got a ton of support, a ton of it at 3,450. So on spot gold contract that does not reflect the true fundamental value, there are your support levels as requested. Now we're looking at spot silver, and spot silver has closed below that 50-day moving average. So I didn't log that because that's okay, but the distance from the 200-day moving average is still extreme at 57.45%. 10% is a lot. So that is an extreme long-term trend or long-term breaking. And it shows that an even more extreme divergence, more than 50% above its 200-day moving average. This is not the physical world. This is the paper world that I was just showing you with lots of shorts and traders and going back and forth. They don't give a crap about the true value of gold or silver. They just care about the little bit that they make up in between. And these kinds of moves in both spot gold and spot silver, they're very rare. It doesn't happen in calm markets. It happens when the paper side is overloaded, and we are in this transition right now as you and I are talking. And it is the most leveraged metal in the system. The paper claims, I can't even determine what they might be because they're buried in so many different places. And when traders place those big directional bets, right, then governments intervene when they go wrong because they're too big to fail. But you and I, we're just the right size. So let's take a look at the support levels in spot silver. The first one that I find is 59. And it doesn't mean that it's going to go down to that, mind you, but you asked me where the support is, so I'm showing you. We've got a support level of 59. The next one below that is 55, and the one below that is 39. Do I think that we're going to get to the 30? No, I think those days are gone, long gone. And that's just fine. Do I think that it can test it? Yeah, but it can stay in this range, giving that 200-day moving average an opportunity to catch up.
Gold and silver markets are entering a critical phase as paper contracts begin to show visible strain. Recent technical data reveals spot gold trading nearly 10% above its 50-day moving average and more than 37% above its 200-day moving average, signaling a sharp divergence from its long-term trend. Key support levels for gold stand near $4,400, followed by $3,900, and strong structural backing around $3,450. Silver shows even greater volatility, remaining over 57% above its 200-day moving average, with support identified at $59, $55, and $39. This extreme separation is driven largely by leveraged paper markets, futures, options, and swaps, rather than pure physical demand. When leverage dominates price discovery, instability increases, and volatility follows. As the transition from paper pricing to physical supply dynamics continues, understanding these support zones becomes essential for risk awareness. In periods of financial stress, disciplined positioning and awareness of long-term trends remain critical for protecting purchasing power. Enjoyed this update? If this analysis helped you, smash that like, share with other investors, and subscribe for the next big precious metals update.